Hello, and welcome to the Wade Borth Podcast. I'm Wade Borth, your wealth strategist, and today we're going to talk about the infinite banking process. I get asked many times by agents, other agents, and clients, and potential clients, what is it that you truly do? What is it that you do? And my simple response is, I teach the infinite banking process. And of course, the follow-up question to that is, well, what's that? If they hadn't heard about it. And what I like to share with those people is that I help hundreds of my clients take millions of dollars and take control of the banking function in their life, the financing function in their life, which is the most important function in your financial life. And I get some pushback because they're not certain about what that is, because when people don't understand something and they don't know what it is, they have a hesitancy towards that product or process. And all I try to do is share with them that it's just a process about how we think about our money. What is it we do with our money? And again, if you go to sagewealthstrategy.com, there's a number of blogs and podcasts talking about conditioned thinking. And we're conditioned to think that if we want to finance something, if we want to use our money or use money to buy something, there's only one place to go get it. And there might be two, but the one place most people are conditioned to believe is that you have to go to a traditional bank. And some people might say, well, I only pay cash. And that's great. That's a step better than using Wells Fargo or Chase or whoever else you might be using. But one of the big benefits of understanding this concept is no matter what you do, you finance everything you do in life. And so what we're talking about is gaining control over this idea that life can't be exercised without a traditional bank. And all I'm saying is take control of that banking function, bring it in-house, do it yourself. Now, is it easy? No, it can be. It can be as easy or as hard as you want to make it. But there's three things that really make that you have to understand and do to make this concept happen. And that's time, money, and discipline. Time, it goes back to my founding principles, and really there's a book by that started all this, a book called Becoming Your Own Banker, The Infinite Banking Concept by Nelson Nash. And what he talked about is he was a forester by trade, and he was talking about what is your concept of long term. In the forestry business, long term is 100 years, 200 years. That's long term thinking in the forestry business. And so his point is that this should be a lifetime process, not just an event in your life. It needs to be a lifetime process where you take control of that banking function. And really, and I've talked about this on past podcasts too, is changing the environment that you're operating in. Don't operate in the environment of having to be beholden to some clerk at the bank to stamp your application and say, yes, you can have this money. No, you can't have this money. Why do we put ourselves in that position? And that leads to a lot of fear and because we have loss of control. So fear and anxiety stem from that. But the idea is that from a long-term process, we want to understand that the banking function is just the fact that we finance everything we do in life. If you pay cash, if you pay Wells Fargo, no matter what you're doing, you're financing everything you do. And what we mean by that is, even if you use cash, what could you have done with that cash had you not purchased that particular item or that particular investment or that piece of ground or whatever it is that you're wanting to purchase? And because of that, we should say, well, if we're going to use our money, we should understand that there's a cost to that, and we should repay our own family financing business. And again, I'd redirect you to a podcast and a blog I've done on sagewealthstrategy.com. Just hop over there and listen to it as well. If you're already here, you can just switch over afterwards. But basically what it says is that we have to love ourselves and to love our family more than we love Wells Fargo. And what I mean by that is if we use somebody else's money, we're more than willing to pay interest and principal on that money. So the question is, why aren't we willing to do it with our own money? Why don't we love our own money as much as we love Wells Fargo's money? So it's having that kind of that paradigm shift or that mind shift saying, well, yeah, we should. It's like any other business. If you have a hardware business and you go into your own hardware store that you own, and you take a hammer off the shelf and you don't pay for it, what does that do to your business? It's detrimental to your business. It doesn't allow you to buy future inventory. It doesn't allow you to keep the lights on because you're willing to go in there and, in essence, steal your own product off your shelf. Now, we may not see it that way, but in all reality, that's kind of the way it is. We're stealing our own product, and it doesn't allow us to buy future inventory. Well, the business of financing, our inventory just happens to be cash. And so when we use cash for something, what is our plan to recognize the value that it has and to pay it back with principal and interest? And so the infinite banking concept is just that understanding and realization of what we have there, and to treat it with respect, because our cash and our assets are super valuable. I mean, people that don't understand that you should pay interest on your own money don't have a lot of respect for their own money. They don't see their money as being valuable. And what I'm here to tell you is that your cash and your money is the most valuable thing financially that you have in your life. It's something that you have your control of. You have the decision where it's going to go. But once you make that decision, the other part of it is, now what's the follow-up? There's a lot of people that follow Dave Ramsey, and Dave does some good things. He understands that debt is a killer. But what I don't think he goes far enough is the fact that if you use cash for something, your cash is super valuable. And so what he doesn't talk about, and what that whole financial entertainment industry doesn't talk about, is paying cash for stuff is great. But what are we doing to replenish that? What are we doing to say, hey, the use of that cash was valuable to me. It got me out of debt. But now what's my responsibility to my own family and to my own business, to my own quote unquote financing company inside my own inside my own family, to repay that? I was willing, if I had credit card debt, I was willing to pay Visa or MasterCard 10, 12, 15%, 20% interest. Why wouldn't I, if I have cash and pay that off, why wouldn't I do that to myself? Why wouldn't I put myself in the position of being the banker in this idea? So again, no, it's just how we think about money. It's not a get rich quick scheme. It's just a change in thought process. It's how we think about money. That is the key to the concept. And again, it's that time period. It's not an event, and it's sometimes hard to look at this and say, oh, I have a 2-year time horizon. Well, if you're a short-term thinker, this really isn't a concept that's going to fit you well. I've had to share that with some clients that want instantaneous results, and we can find some instantaneous results, but quite frankly, it's a long-term process that we need to think about. So again, one of the first keys to this is time. The second one is money. It's about capitalization. If you think about it, again, Nelson Nash in his book, Becoming Your Own Banker, talked about we're in two different businesses. He actually wrote a lot. The first half of his book talks about the human equation. And it's, again, fighting some of the concepts, some of the ideas that entrap us. And so you have to fight that. But one of the things he did talk about was that we're in two different businesses. We're in the business that you get up in the morning and you put your clothes on and you go to the office, or you hop in the tractor, or you open your shop, or whatever you're doing. That's the first business you're in. The one that we don't always realize that we're in is that we're in the finance business. Because again, you finance everything you do. If you pay cash or however you do it, understanding that and treating it like a business is what people that have wealth understand. And again, I'm not here to kind of make this up out of whole cloth. We just look at what people of wealth have done, and they understand that the finance, whoever controls the financing, wins the game. That came to me from a CPA one time. He's like, whoever controls the financing is the one person that always wins in the transactions. So having a client that came along, it was an interesting story that he looked at this idea and he wasn't 100% on board. But he says, I'll go along here because he says, I see something there that there's some truth to what you're saying. And so over the process now, again, we have to think long term, and he's only been a client of mine of about 7 years. And in the meantime, what's happened is he used to flip houses, and he needed to borrow hard money from hard money lenders. He had to borrow money from hard money lenders. Well, he went from being this borrower to the point where he would take the profits from his flip, and he would hold on to that money, use that for his funding of himself. And after a couple of flips, he had enough money so he could take the money and that he'd saved up, and he would flip a house, and now he didn't have to go to the hard money lender. The point I had to make to him, and again, it was multiple conversations with him, was that once you make the loan to yourself, so his personal financing company, again, it's not really a company, it's just the way we have to think about it, is that I'm going to hold money, and then when he went to get to do a flip, and he needed $20,000 to do some renovations, he would take the money out of his account, borrow it from himself to lend to his real estate company, as it were. Again, we have to silo these things a little bit so we understand that each one has its own profitability. Because if we're not doing that, how do we know what we're doing is profitable? And so then he took that money through conversations we had with him. He says, okay, I was paying a hard money lender, I was paying 14% interest. He says, I'll do the same here. And then, because what we want to do is be able to judge this flip compared to the other flips. And if he's not paying the same interest as he was, how do you see if it's just as valuable? How do you know if you're progressing and you're making progress or what you're doing? So then he took that money and he paid it back after he sold the house that he was flipping with the interest, and his account grew. And then he did it again, and his account grew, just like it was growing in somebody else's account. Now he's taken that process inside his business or inside internally. And he was like, wow, it's really starting to grow. Now to the point where he doesn't even flip houses anymore. He's now become that hard money lender. And it works well for him, mainly because he understands what's a good flip, what's not a good flip. If somebody would default, he has a lien against the property. And so he's in a position to let his money do his work for him versus him working for his money all the time. So when we look at that, this is truly a business that we try to get people to understand that they participate in every day. Now, if they recognize it or not, that's a different story, but they participate in it every day. Then what happens is once you've built up enough, now you can start going and doing other things. You can use it. Like this one client of mine, he was using it now to become that hard money lender. So like any other business, it takes capital. It takes time and money, because we talk about that in other podcasts, that capital is what's important to you. So it's time or money, or it could be other things as well. But those are the two big ones. And he's taking his time and his money to understand the business that he's in. He's in the finance business, so he's taking time to understand it. And now he's got to capitalize it with money. And so just like any other business is that you need to capitalize. Don't be afraid to capitalize. Nelson Nash always shared that with us when I first met him about 15 years ago. Is the biggest problem with businesses is that they're afraid to capitalize. And he says that's really one of the big things in this concept is if you truly understand that you finance everything you do, and that's a business model that you're in, he says you need to capitalize. And so, again, what it takes time, it takes money, you have to capitalize. And the third thing, which is really the most difficult thing for me to teach, because it's either you have it or you don't for the most part, is discipline. Because you're the easiest person for you to fool. And what I mean by that is you can convince yourself of pretty much anything you want yourself to be convinced of. And so if I borrow money from myself to, say, buy a piece of real estate or whatever the case might be, I can tell myself, I can take my real estate person and convince my banking person, again, these are all in my head, that, hey, I'll pay you next year when this property starts to cash flow even better. Well, hey, that's great, but could you get away with that if you went to Wells Fargo and had that conversation with your banker at Wells Fargo or your credit union or wherever it's at? No, they're going to want principal and interest. Now, part of being your own banker, you controlling that banking function, is that, yes, you should have that. You do have that flexibility. Not that you should. You do have that flexibility. But it takes a tremendous amount of discipline not to abuse that. There are stories of in the 80s of some of the richest banks in this country that went bankrupt because their board of directors are the ones that had the most outstanding bad loans on the books. So they had their board of directors weren't paying their bills. And so the bank, in essence, had to close the stores. And it was one of the richest banks in the country. And so it's the same way. You're on your own board of directors. So you should say, I owe this to my family. I owe this to my business to make this loan payment back. Because nobody else holding you accountable. So again, it comes back to discipline and accountability. If you have the discipline to understand that, and that's what you're going to do to grow wealth, you're going to say, well, I'm going to write up a loan document. I'm going to write up an amortization schedule. I'm going to have in there penalties for late payments. All the things that you're willing to do if you do business with Wells Fargo. Why aren't you willing to do that and more to your own business? Why do you want to treat your business worse than anybody else out there? Shouldn't your business be the most valuable business that you do business with? So again, changing that mindset, because again, I hear people all the time. Well, I ask the question of my clients or new people, and when I get to know them, they're not my clients yet. I'll say, are you a long-term thinker? And of course, most people are going to say yes because they believe they are. And that's great. And then the next set of questions is just really to determine where they're at on the thought process. And that question typically goes, if I had $40,000 in my savings and I'm going to buy a car with it, for example, and you take that $40,000 out of savings and you purchase the car, do you plan on paying that $40,000 back? Do you have a plan to pay that $40,000 back? 80% of the people or better are going to say, no, what's my money? Why should I pay it back? Is what I hear all the time. And I'm like, well, okay, I know where we have to start there, because they don't have the discipline or the long-term thought process to understand this. And I'll say, okay, now I do get the people that say, well, yeah, I need to put it back because they understand that if they want to buy the next car, that they have to build up those reserves. And I say, if you do that, you're in the 20% bracket of people that understand that they have to put the money back. And then I'd say, well, would you pay that back at 8% interest? And of that, of the full 100%, less than 10% would say, yes, I would do that at 8% interest. And the reason why they think that is, well, why should I pay interest on my own money? I understand I got to put the principal back, but why should I pay interest? Again, it's if you would have that cash available to you, what could you have done with it besides spend it on a car? Could you have bought a piece of real estate? Could you bought a piece of ground? Could you did hard money lending to somebody else? Those are all things you could have maybe made 8% on, or 10 or 12 or 15, or whatever it is. So if you wouldn't use it for that, you could have earned a whole lot more. So for you to buy that car, shouldn't you at least pay it back at 8%? This is called lost opportunity cost. And again, nobody, when I used to use that term, people's eyes would glaze over. I'm like, okay, I'll stop using the term. But that's that whole idea of that. If I spend money on something, could I have used it somewhere else? And if the answer is yes, then I'm not saying don't spend it on that one particular thing. I'm not saying don't buy a car, but understand that there's a potential cost that you could have, so you should pay it back with interest. Now, that interest is staying within your system, so it's not leaving. It's not like it's going to somebody else's pocket. It's staying within your system. All it is a recognition of a cost. And there's a whole study back in the 70s about economic value added, and you can look it up and you can can read about it. Maybe I'll write a blog about it as well. But this idea that, and Coca-Cola was a great example of this, is that they had a ton of cash at one time, and they go, hey, we should open up regional bottling warehouses so they can bottle their products and then ship it up. They're going to build these because they had a lot of cash. So they used their cash to do it. And then what happened, the gist of the story is that these things look great on paper. Hey, we're making all kinds of money. We should have did this years ago. And then some bean counter, some accountant comes along and says, well, we were making, again, this is back in the 70s, we were making 6 or 7% interest on that money. We built these plants and we're not charging them anything for the use of that cash. And so the kind of light bulb went on. They go, hey, we should at least charge an interest. And now this seems revolutionary, right? And I was like, well, of course they should have charged. But back then they did. And they go, we should have charged interest for this. And so they go, okay, we're going to charge interest. They charged a reasonable rate of interest, 7% rate of interest back in the day. Half those bottling plants became non-profitable because now they had to recognize that there was an interest cost that they weren't having to pay before. And so it helped them, fine tune and say, well, if they're not profitable, we either have to close them or find a way to make them profitable. It forced them to be a lot more efficient with their dollars, because now they could recognize that there was a cost to running these things, the cost of capital, cost of money. And they just applied it. Now, did it leave their system? No, it stayed within their system. It just was accounted for. They looked at their bottling plants separately than they looked at their general account and Coca-Cola in general. So they could have closed half the plants because they weren't profitable at that time, because now they had this interest rate cost associated with it, which makes perfect sense. If you think about it, if they would have went to a big New York bank and said, hey, this is the expansion we want to do and we want to finance it, they would have paid that cost and they would have had it on their books as a cost, and they would have said, okay, we can make these things work, and they can make a reasonable assumption on their business model if it was going to be profitable. But because they didn't apply an interest, which most Americans do, they use their cash and they don't apply an interest. They don't understand what the real cost is. And what they're doing, is it profitable? So we're not saying that you shouldn't do that. You shouldn't buy those products. What we're saying is that when you apply that interest rate, then again, if I use real estate or farm ground or whatever it is, then we can look at it and say, well, is this something I should really stay in? Is this something that's profitable and that we want to stay there? So again, the infinite banking concept is just that in itself is the process of how we think about money, how we addressed our most valuable asset financially that we have is our cash and our money. And what we're doing with it and what interest we're charging on it will tell you what we think about that money and how valuable we think it really is. And so to get a handle on the infinite banking concept, again, what it takes time, because this really should be a lifetime. And quite frankly, in my life, more importantly is that I want to empower my son to get this a whole lot earlier than it took before I got it and understood it. So really, I want to make this intergenerationally. And if you think about it, there's very successful families in this country, the Rockefellers, and to name just name one, that this is what they do. This is what people of wealth understand, is that when you use money, it's like having your own store. You should at least pay retail, if not retail plus 2 percentage points, because it's your inventory. In this case, isn't clothing. It happens to be cash. Now, the next part we'll talk about is where we're storing that cash, and we'll talk about that down the road. But again, the infinite banking concept in itself is something that takes time. You have to capitalize it. You have to have the discipline to do that, and the drive to say, well, I'm going to set dollars aside. And when I use those dollars, I have to have the discipline to say, well, because I'm using my financing dollars, I need to have a finance charge and expense, and it needs to come back so we can recognize what the true cost is. Again, not leaving your system, but just still being inside your system. And you're just using it as a way to recognize what the true cost of something might be. And to say, yeah, this is a profitable venture that we're in because now we recognize that there's a real cost of interest. And the cost of interest, doesn't matter if it comes from Wells Fargo, or if it comes from, in my case, the Borth Family Bank. It shouldn't. Because it's, again, when we look at it, we say, yeah, this is profitable. I want to do business with this financing company, which happens to be the Borth Family Bank. Again, what is a Borth Family Bank? It's just a checking account. It's just a separate. I mean, it's nothing extravagant. It doesn't need a charter. It's a mindset of how you think about money. Because again, we're financing everything we do. So again, I would encourage you to, if you want to have a further discussion about this, send me an email. It's wade@sagewealthstrategy.com. Again, that's at wade@sagewealthstrategy, singular, with a Y at the end, .com. Hop onto our website, ask for a review, and let's talk about how we can change your paradigm and get to the understanding that by controlling the banking function in your life, you're going to take over one of the most valuable things that most businesses and households have abdicated to somebody else, and that's the banking function. And it's not because we don't know any better; it's just that we've been conditioned to think that that's the only way to do it is to go to an institution that's what they do. Well, the question is, why can't we do that ourselves? Why do we have to give that most valuable part of our function, of our financing, away to somebody else? So again, drop me an email, wade@sagewealthstrategy, or hop on to sagewealthstrategy.com. Take a look at our other blogs and podcast, and have an understanding that this is something that everybody can do. It can benefit everybody. It's just going to take time, money, and discipline on your part, and I'm here to help you along the way, because this is not a process that it's not an event. It's a process that you're going to do over your lifetime, and you maybe never master it. Again, I've been doing it for 15 years, and I learn new stuff all the time about this whole concept. So you may never master it, but you're on the road to mastery once you get into this. And again, it's your lifetime, the next generation's lifetime. This is something that true wealth creation is going to be passed on to the next generation, because giving in the book Richest Man in Babylon, the question is, what's more valuable, the gold or the ability to earn and keep the gold? And of course, the answer to that is the ability to keep the gold. And if you haven't read The Richest Man in Babylon, I encourage you to do that, because it's a great story. It doesn't take very long to read. Same with Nelson Nash's book. It's 96 pages. You pick it up. It talks about the human condition. It gives you some examples, and get you to think about how you can take control. In his book, he talks about taking control of changing the environment that you're in. Don't think there's a special product that works better than another. When the real question should be, well, do I belong in this environment? Do I belong working with Wells Fargo, or is there a better environment I can work with? So change the environment that you're in. And then it doesn't matter what products you're using, because now, 35% of what your income, what you make, goes towards financing. And if you can take control of the 35%, that's a way bigger number than trying to figure out, how do I get, instead of getting 8% of my investments, I get 10% of my investments. Imagine if you could take control of 35% of what your income is each and every year. So focus on the right thing versus, being distracted by the small number that really we have very little impact on. So again, read Nelson Nash's book, Become Your Own Banker. I'd love to have a discussion about this. It's a passion of mine to teach people how to take control of that banking function, how to get into that process. Again, it's not a product. It's not anything else. It's a process about how you think about money and what you do with your money. And then, getting into that process is the key. And then once you understand the process, then we'll talk about what are the products we should be using in this process that is like, it's the best product that fits this concept. Because again, it's not something that I made up or Nelson made up. It's been time tested over hundreds of years. So we can talk about that as well. So again, reach out to me through my website or through email, and let's have a conversation about how you can take control of your financing and what you finance in your life. Thank you.